Hey guys, Chad Larson with MLD Wealth. This is October, Money Matters. Sorry, we're kind of 10 days into the month here. I was in Toronto all last week, meeting with the Variable Brain Trust of our firm and broader industry, taking stock of where we're at, looking at strategy, looking forward, and kind of making sense of the current context. Part of me, was stressed. It was Thanksgiving this weekend, some time with family and friends, and I came into the office yesterday on the holiday to start putting the pen to paper, so to speak, and the notes together. So as much as there was a guilt that I'm a third of the way into the month, anything I would have said last week would be semi off the table, or I would be doing a flash communique. So today's timely format is going to be very ad hoc, but I hope informative. A lot to unpack here. So last week with the Variable Brain Trust of the firm, with Martin Roberge, Tony Dwyer, our chief market strategists, and had a very interesting fireside chat. Our keynote speaker that we brought in to take stock of the world was the Right Honorable Stephen Harper, who served as Canada's 22nd Prime Minister from 2006 to 2015 to get his insights and outlook from the geopolitics that shape economic policy, shake central bank policies, and ultimately affect the marketplace. I've been saying, and so as much as I'm excited to talk to the topics, this one could be long, so bear with me. I kind of feel parroting that a lot of the times we're saying a lot of the same things over again. Again, back to January, we expected the markets to be very choppy into the front half of the year and more constructive into the back half of the year as we saw economic recovery in 2024. Last month, we pivoted that outlook as the Fed's tone for higher for longer, that interest rates, as we've seen the most sharpest rising interest rates since I've been doing this for a career, which is over 20 years. So let's talk a little bit about that in a second. Next week, I am in Los Angeles for 2 full days of meetings with Blackstone, the likes of KKR, Apollo, Goldman Sachs, and interestingly enough, Mike Pompeo, the former Secretary of State and Director of CIA. What does any of this have to do with our money, with your money, our positioning strategies, and our tactical outlook for the market? Given the events of what happened over the weekend in Israel, this is going to be something that we've talked about in the world, is that there's two risks in the market at all the time. There's the known unknown. When will interest rates change? When will Fed policy pivot? And then there's the unknown unknown. And that unknown unknown became very apparent over the weekend. We've talked about this, obviously, the Russia-Ukraine conflict, and now we have Israel and Palestine, the New World Order. So Russia has started the largest war in Europe since World War II. China has become bellicose toward Taiwan. India has pivoted and embraced a virulent nationalism. And now we have, Hamas brazenly attacking Israel, launching thousands of missiles and publicly kidnapping and killing civilians. All of these developments are signs that the world may have fallen into a period of disarray. Countries and political groups like Hamas are willing to take big risks rather than fearing the consequences that would become too dire. The simplest explanation of this is that in a world in the midst of a transition to this new world order, it's what experts describe as the world multipolar. And Stephen Harper made the comments about of being in a Cold War. The United States is no longer the dominant power it once was, and no replacement has emerged. As a result, political leaders in many places feel emboldened to assert their own interests, believing the benefits of aggressive action may outweigh the costs. These leaders believe that they have more sway over their own region than the U.S. does. So a fully multipolar world has emerged, and people are belatedly realizing that multipolarity involves quite a bit of chaos. This is, there was a Chinese political scientist named Shen Zhangjian with ties to country leaders, has similarly described the old order as disintegrating, and countries are brimming with ambition, like tigers eyeing their prey, keen to find every opportunity among the ruins of the old order. So, why has American power receded? And some of the changes are unavoidable. Dominant countries don't remain dominant forever, but the U.S. has also made strategic mistakes that are accelerating the arrival of a multipolar world. Among these mistakes, presidents of both parties naively believed that a richer China would inevitably be a friendlier China, and failed to recognize the U.S. was building up its own rival through lenient trade policies. In Afghanistan and Iraq, the U.S. spent much of the 21st century fighting costly wars, proving to be incredibly costly. And perhaps the biggest damage comes from a stance that the U.S. no longer wants to be the world police, so to speak, and signaling, potential pullouts under a Republican regime of pulling out of NATO and abandoning efforts in Ukraine. So a lot of politicism here today, and I try to not let my politics come into the fray when it comes to addressing economics, when I come to address the atrocious, brazen disregard for human life and breaches of human rights. I'll let that speak for itself. I want to, and sorry, just a moment there. It's incredibly horrible what's going on in the world. But listen, I think one of the things why I speak to that is this unknown has become known. And, over the past 2 decades, it's become fashionable to lambaste American hegemony, to speak derisively of American exceptionalism, to ridicule America's self-arroganted function of world police, and to yearn for a more balanced or multipolar world. Well, congratulations. Now that we have that world, I think we're all going to see if we like it better. I think there's going to be a lot of chaos. The world has lost globalism and is now being more centered around in that, where does this create opportunity? We will see, but there's, a lot of volatility unknowns that are coming into the market right now. And so, okay, do we sell everything? Do we go run and hide? I want to say, listen, it has been a difficult couple of years. This year on paper, it looks like the S&P is up 10%. A balanced investor is not. At the same time, and I'll tell you why. We've talked about it over the past number of sessions, and I've talked to many of you over the phone and in person, and have heard me on this podcast. The market's returns are incredibly narrow. The exposure that we would have from being diversified and looking to preserve capital would never concede to a strategy where we had a third plus of our money concentrated in 7 stocks. So this is a time where the S&P looks like it's up. It's kind of a benchmark we lean to for it captures the largest swath of the largest economy in the world. But at the same time, the Dow Jones Industrial Average, the New York Stock Exchange Composite, the Russell 2000, and the equal weight S&P are all negative on the year. So we've talked about this, the concentration to a handful of tech stocks that have driven the market. The market has dubbed them the Magnificent Seven. But 7 of the 11 sectors of the market, between consumer discretionary, staples, health, banking, industrials, metals, materials, energy, all of the sectors, there's 7 sectors that make up a market, and call them the food groups. 7 of the 11 of them are down on the year. So clearly the Magnificent Seven is providing the narrowest market I've ever seen in 20 years, and has created the perception of a good year for stocks off the back of a dismal 2022, where the benchmark for a balanced investor was minus 18%. And, hopefully for the last time I get to use this, or I'll just take a pause from doing the podcast. While I'm very cognizant and respectful that relative returns don't fund retirement and pay the bills, I'm very proud of the positioning strategies and tactical nature in which we positioned last year to avoid calamity. Now this year, the front part of it, we lagged broader indices because of our conviction to things like the energy trade and oil, specifically oil and gas. Those sectors did terrible in the front half of the year. So we were trailing the race. You were falling behind in 2023. If we measure each year and did I want to say we're going to pivot and do some window dressing and jump on the bandwagon? No, we were consistent in our outlook and our viewpoints. So that's changed. And we can speak back upwards or earlier to the podcast. You can imagine what energy prices are doing now that there's massive geopolitical conflict, and the Middle East looks like it could be going into another cycle of significant conflict. But this narrow market that we've seen has created this perception of a good year for stocks that just hasn't been. With those few stocks, we've seen also even the Magnificent Seven, we've seen a significant sell-off over the last few weeks as well. So to put that in perspective, these 7 largest stocks in the S&P 500 have returned 92% on average this year. But it's not terribly healthy for markets. Again, if your generals are so far down the battlefield and your soldiers are falling behind, you can imagine what's going to happen if 1 or 2 generals gets hurt. You could see, large pockets of vacuums within the marketplace, and we don't think this is sustainable. So all of this volatility in the marketplace has brought 2 of the 4 key tactical indicators that we look at that would suggest you have a counter trend or an environment for a bounce. And so we could be seeing a bounce in the market right now. And people are saying, okay, is this the time? We've been waiting, Chad. We've been waiting where, we have a lot of liquidity within our core portfolios. We keep talking about keeping tactical. Is this the time to go all in? As I've been super clear, we don't want to fully play until we have an improved outlook for money. What I mean by that is the outlook for money that comes from a dramatic change in the tone from the Fed that causes significant and sustainable drop in U.S. Treasury yields, corporate high yield rates, and even investment grade rates, and of course, long-term fixed mortgage rates. You've got to have something to stimulate an improved outlook for money that's going to cause an improved outlook for growth. Ultimately, investing is investing in growth of the economy. Now, a lot of things can be true at the same time. But when we look at, and I've said this before, I'm academically trained as an economist, and a recession is categorically 2 quarters of negative economic growth. I've said we've been in it for a while, but the U.S. has staved this off, both from a reclassification of the inputs of what that may look like, but the U.S. market has been incredibly resilient as during this incredible steepening of the yield curve and the most accelerated rise in interest rates that we've seen, again, since I've been doing this for 20 years, you've had massive stimulus into the market through the Inflation Reduction Protection Act, through the infrastructure bill of the U.S. The U.S. has, again, poured $2.3 trillion of stimulus. Government debt is ballooning, though. And, potentially, there's a small tail risk for a debt crisis in the U.S., albeit small, never unheard of. This would be a problem for everyone thinking long-term capital management crisis of the past. But all we're seeing right now is stabilization, and we continue to remain light and tight until you get a fundamental shift in the outlook for money. Other things that, we kind of want to talk about, through this is, what does that mean for us? Should we go to cash? Should we look at buying GICs now? We're seeing structured GIC notes now with interest rates of 6%. Most financial plans or family index numbers are built around numbers like that. Should we just bail out, hit the easy button? Now, for a myriad of reasons. 2, this has been a one and unique time. Now, if there was duration available and we could buy 15-year bonds north of 6% with the risk of a government security, maybe. But we're talking about 1 and 2 year duration because the yield curve is steep. Rates are higher, closer, and lower further out. So we don't want to be in a situation where we park, we pull out. We make 6% for 1 to 2 years. Well, 1 to 2 years out, what does the world look like? We know that over time, equities do outperform treasury rates. In fact, they're priced off of a spread of those. And so and additionally, the taxable nature being very inefficient with interest income, I have to set the table, and I think this really rues out shortly. It's during periods, it's during a bear market, you make all your money, you just don't know it yet. And I know that's a colloquialism. The reality is, and what we have to be prepared for, and why we have to be congruent in our people, our process, and our philosophy, and really aligned to what we're doing, is I think at an economic level, it gets better, but at like a true, even spiritual level, people's mettle is going to be tested, because remember, it's during a recession that markets make their bottom. If this was one baseball game, we're in the eighth inning here. The institutions and pensions have hedged out. There's incredible amount of liquidity on the sideline. The only last thing to shake out would be, a retail investor kind of giving up and throwing the towel in. When things turn, and it will be during the period, it's doing the hardest things. It's doing the right things at the hardest times, which become the impossible. And that is, growth is found during periods of being uncomfortable and during periods of pain. So when we see an acceleration and peak terrible economic data coming out, joblessness numbers, mortgage default rates, negative earnings revisions, you're going to see that all means this tightening phase or quantitative tightening that's gone on has worked and is working. At that point, you will see the inflation contract as companies perform poorly, economic productivity comes down, housing prices come down. That means the Fed will have the confidence to stimulate the market and to balance out the market. If and when we do see, and it is not an if, it is a when you see a structural shift of the Fed to ease money, to accommodate policy, and money comes flooding back into the market, you will see a structural bull market develop, and you will very quickly not wish you were trapped in a 2-year GIC, because when the markets turn, they will turn aggressively. So I guess what I'm asking is, list all of the feelings that you're having. It's something I've said many, many times before. How you feel about the market and how you feel about your investment strategy is equally as important as what you're invested in. We're here to be the calm hand. We're here to be pragmatic. We're here to give advice. We're here to talk through complex economic situations and variable inputs that are happening live 24 hours a day across the world to ultimately achieve what our goal and what our job is. And I said this to my team this morning. Every Monday morning, we have a town hall internally within MLD Wealth where we talk about the week in front of us over the weekend. What are the key things we're working on? And Tuesdays, I get up on my pulpit, so to speak, and give the lay of the land from an economic standpoint, but from an investment positioning strategy. Ultimately, we are here to construct portfolios for high quality people that are our private clients that, amongst other things, seek to position capital to the best way possible to give them the highest probability of achieving their goals over the long term. There's things we can control and there's things that we can't. There's things that are interesting and there's things that are important. We try to push things together as much as we can. And ultimately our goal is to construct portfolios and position families to have the highest probability of achieving their goals over market cycles. During periods like this, again, our job is to hold the line. Our job is to have less downside capture. And I want to leave that where I'm banking in on the 20-minute mark. Academically, there's only one way to outperform the market. It's to take on more risk. The other way is if we can be in a scenario where we have less downside capture as a percentage base than upside capture, arithmetically, we will outperform over the long term. We're looking to that benchmark to the family. And I look at it and say, be congruent in your how you approach your investments, be congruent in how you approach the dialogue or discussion in and around that, and don't allow emotion to come into play. Feel free to contact myself or any member of the team at any time. I think things are going to get choppy at an emotional level. There's going to be a lot of noise on the headline. We're here for you, and I hope you guys have a wonderful balance of October. If anything happens even more crazy over the next couple of weeks, I'll do another one of these. But again, my office, my line, my email, constantly open. I look forward to feedback. I look forward to commentary. Again, I try not to be as old school as to direct Outlook and pick up the phone 100 times to have the same 100 conversations. I hope you find this valuable, but at any time, if you have a concern, it means it's important to myself and my team, and feel free to reach out.